All right, so let's get into the subject of this podcast. Let's talk about charity, and specifically some of the vehicles you can use for giving to charity. I got a couple of email questions here. The first one is a simple, I'm hoping you could talk a bit about donor advised funds on an upcoming podcast. What are their benefits? Are there any drawbacks? What kind of asset allocation should we use? And any thoughts on whether to use a Vanguard or Schwab DAF versus one that's available through a very well-regarded nonprofit in my city? Then the second one via email is a lengthy one from a doc who wants to maintain some anonymity, but basically asks, can you go in depth on DAFs versus CRTs, charitable remainder trusts, versus private family foundations, their pros and cons? The background here is we're FI physicians in our 40s and are looking to maximize some tax deduction opportunities for the current year, given our high marginal tax bracket. They basically have some highly appreciated securities they don't necessarily want to pay capital gains taxes on, and they also have some charitable desires. All right, so let's talk about these three different types of vehicles. First, the donor advised funds. You may know the most about these. I've written about them many times. I'm sure I've talked about them on the podcast at some point in the past. Katie and I, we have a donor advised fund at Vanguard. Vanguard is not the easiest one to work with. I think Fidelity is probably the easiest one to work with. They have lower minimum initial contributions and lower requirements to keep money in there without paying additional fees than Vanguard does. I think you can make smaller donations as well. I think Vanguard's minimum donation is like $500, meaning when you take money out of the DAF and give it to the charity, you got to give at least $500. So this doesn't work if you're giving $20 at a time. All right. If this is, you're just contributing to your local elementary school or you're giving a few bucks here and there, donor advised funds really don't work. Okay. Fidelity works a little bit better in Vanguard, but for the most part, these are for significant donations you're going to be making to charity. If you're not going to be making significant donations, don't bother with a donor advised fund. The basic point of a donor advised fund is to provide you a few things you can't get going directly to a charity. Okay? One of which is anonymity. When you give money to a charity, it's really hard to remain anonymous. And all of a sudden, your mailbox gets flooded with what I call charity porn. Okay? Not only are you getting all these glossy brochures from that charity for years and years afterward, but they actually sell your name and address to other charities to send you more charity porn. So all of a sudden, instead of helping all these people you're hoping to help through charities, the charities are using the money to market to you to get more money. And I'm not a big fan of that. So I like the anonymity that comes from using a donor advised fund. They don't get my name. They don't get my address. They can't send me any charity porn. So theoretically, more of my money is going toward actually helping the cause that the charity works on. So I like that aspect of it. Another advantage of a donor advised fund is you can give the money now and get the tax deduction. And then you can wait to actually give the money to charity. You can give to charity in a year, 5 years, 10 years, 80 years, whatever you want. You can leave all that money in your donor advised fund. Now, you can't take it back out and spend it on yourself. It can only go to a charity, but you don't have to give it to the charity right away. If you want to spread, you want to get the whole tax deduction for your donation this year, but you actually want to spread out the giving over many years, then a donor advised fund works very well. I call that a bit of a jerk move in some ways, in that you're getting the benefit now and the charity isn't getting the benefit for a while. But I'll let you deal with the ethics of that. That's one thing people like about a donor advised fund. And it can make sense, right? If you're in a high tax bracket now, you're not going to be in a high tax bracket later. Well, you might as well get your charitable deduction now, or maybe you're selling a company or something. And so you want to get that money in there. You can see why that would be an advantage. So those are the main benefits of a donor advised fund. It's also a little bit slicker come tax time because you just got this one big donation to keep track of for charity. And then DAF gives you all the documentation for it. And then you don't have to keep track of all these little or smaller, I guess they're not little, but the smaller donations you make to various charities. So it's less paperwork when tax time comes around. Okay, what's the main drawback? Well, you got one additional step. Anytime you give to charity, it's got to go in the DAF, and then it's got to go into then it goes to the charity. So it's one additional step. That's one drawback. The other drawback is the DAF actually charges fees. At Vanguard, if you don't keep 25 grand in there, and the truth is you only have to have 25 grand in there on the one day in February when they check the balance. But if you don't have 25 grand in there, they charge you an annual fee. I think it's $250. Also, they charge 0.6%. And I think Fidelity is something similar, maybe even a little bit higher. So you're paying an AUM fee on any money you leave in the donor advised fund. And if you look at what, 0.6% of $25,000 is, well, you're starting to get closer to that $250 annual fee mark. You're going to pay one way or the other. And so that's the main drawback, right? If you're managing your portfolio for just a few basis points, all of a sudden now you're paying a 0.6 AUM fee. So significant drawback. As you get millions in there, that AUM fee does drop, but I think that's what the fee is for the first million. So, I mean, if you got $1 million in there, that's $6,000 a year you're paying them just for the benefit of the DAF. Now, you can make the argument that DAF fee is pretty darn similar to what the tax drag is if you just left that money in your taxable account. And so maybe it's a wash one way or the other. Obviously that money, once it's in the DAF, is growing tax-free. And so maybe the tax drag and the DAF fee kind of cancel each other out. So no big deal. Okay. So what kind of asset allocation should you use in there? Well, it really depends. When are you going to give the money? If you're not giving the money away for years and years and years and years, you can invest aggressively. You can put it mostly in stocks. Now you're pretty much going to be stuck with, publicly traded mutual funds is pretty much what you're going to be able to use in a DAF. But if you're using the Vanguard index funds anyway, that's no big deal. You're going to have the same funds available to you in the DAF that you will in your taxable account. So no big deal there, but don't expect to be able to invest in private real estate or cryptocurrency or something inside your DAF. You're probably not going to be able to. Although there's probably a market there for somebody down the road that wants to offer that. I'm sure they can probably arrange it. But what kind of asset allocation should you use? Well, we don't really park money in our DAF. The money that goes in basically comes out a few days later and goes to the charity. And so all the money that we have in our DAF sits in cash. It just goes in a money market fund and then it comes out and goes to the charity. And so that's the asset allocation we use, 100% cash. Vanguard, Schwab, Fidelity all have these. I think Fidelity's probably the top one, particularly if the limits at Vanguard bother you. If you want lower contribution limits, initial contribution, and lower charitable donation limits, then Fidelity is the one to use. It really works well if you have your taxable account at Fidelity to use the Fidelity DAF. It works well if you have the Vanguard taxable account to use the Vanguard DAF. It's very slick that way, although I'm told it's pretty darn easy to use a Vanguard taxable account with a Fidelity DAF. No big deal there either. The other option, of course, is one that is, kind of local. A well-regarded nonprofit in your city, for instance. And oftentimes, these are actually run by the charity itself. And so if that's the only charity you want to support and they have a DAF, you can go ahead and use that one if you want. But I prefer a more broad-based one at a typical brokerage house like Vanguard or Fidelity or Schwab. So that's kind of the DAF story, donor-advised funds. They're pretty good. And I think they're very useful for people that aren't super wealthy. In fact, if you're going to have less than, a 7-figure amount is probably where I'd start thinking about some of these other options. If you're less than that in some sort of charitable vehicle, I think a donor advised fund is probably the way to go. All right, so let's talk for a minute about private family foundations. And they are a little bit of a different kind of vehicle. And let me explain why. And the reason why is a private family foundation, you don't have to pay that 0.6 or 0.7% fee to Vanguard or to, Fidelity. But somebody's got to manage the investments inside the foundation. That can be you. You can manage them for free and not charge anything to do that. And you can choose super cheap index funds to put in there. No big deal. So at large amounts, the savings from not paying that AUM fee can be significant. But a private family foundation is basically just a private foundation. Okay, it's governed by the IRS regulations for private foundations. It just happens to be governed and funded by family members. But about 50% of private foundations in the U.S. are family foundations. Family members are often the only members of the foundation's board, and decide how the assets of the foundation can be used to meet the foundation mission by making grants to charities or to even to individuals. And so there's a little bit more latitude in what the money is used for. You do have to, just like any other private foundation, you do have to disperse 5% of assets every year. The grants are also publicly viewable, so you don't get the same privacy you would get with a DAF. So that does take away some of that anonymity. It makes it easier for the nonprofits and donors to learn what the foundation cares about and which causes and organizations it supports. So maybe now the foundation starts getting a bunch of that charity porn. I don't know. It can be founded all at once, when you sell a business, or it can be founded on an ongoing basis with assets. You can give cash to it. You can give appreciated securities, whether they're stocks or mutual funds or whatever. You can use private stock or a family-controlled business or asset or real estate to found it. And it can be managed either by family or it can be managed by a professional manager. You can set it up. Obviously, you're going to need to go to an attorney to set this up. You can't just go to Vanguard Charitable and open up the account. You're going to need to draft some documents, probably involve an accountant as well. It needs articles of incorporation, a mission statement, some other documents. And you have to file a tax return for it each year. And this is not an insignificant tax return. This is Form 990-PF, the return of a private foundation. It's a 13-page tax return. It's not insignificant. There's another regulation with a private foundation. You basically have to pay a tax on the income for the foundation each year. Now, it's not terrible. It's actually pretty low. It's 1% to 2% of the income, not the assets in the foundation. This isn't an AUM tax. It's just on the income. So let's say, it made 5% income this year. Well, you got to pay 1% of that. So it's pretty small, but it doesn't exist when it comes to a DAF. You can do a few other things with it. You can pay your kids to be on the board, for instance. You can give them a salary. The foundation can pay them to be board members. And so a lot of people find that option attractive. And that's kind of it. I guess there's one other thing. You can't quite put as much money into it as a percentage of your income and get a deduction for it. For example, if you put it in a donor-advised fund, you can get 60% of your adjusted gross income if you put cash in there, and 30% if you put appreciated securities in there. So that's pretty good for a donor-advised fund. If you made $1 million this year, you can put up to $600,000 into a DAF and claim a deduction for that. If you are using a private foundation, however, those two numbers are 30% and 20%. So if you made $1 million, you could only put $300,000 into your private foundation. So when do you do it? Well, you do it the year you sell the property or you sell the family business or whatever. That's the year you put all the money in, because you've got this real high income, and so you can get a pretty significant deduction. But you can put more into a donor-advised fund than you can into a private foundation and still get that deduction for it. So keep that in mind. I mean, I suppose there's nothing that keeps you from using both. If you want to put everything from selling a business in there, you could put 60% of the cash into the donor-advised fund. You could put 30%, I suppose, into a private foundation. I don't think those are aggregated limits. But that's basically the point of a private foundation. So why do some people use it? I guess because they want to put their kids on the board. I don't know. That seems to be the main benefit. It's an older thing. Donor-advised funds are a little bit newer, and so maybe a lot of people don't realize it. Maybe there's a lot of attorneys and accountants that are running up their fees by recommending family foundations rather than the easier to manage donor-advised fund. Down the road, of course, I think a foundation probably lasts longer. You can name basically beneficiary advisors to your donor-advised fund if you want. So the next generation can now decide what charities the money goes to. But they can basically just clean the thing out in 1 year. They can't take it themselves, but they can give it all to their favorite charity the year you die, and that's it. The donor advised fund is all over. Whereas a private family foundation usually has some guidelines and some laws, and so it's likely to last longer. Although there's nothing that keeps your donor advised fund from being stretched out for a long, long time if you would like as well. All right, so that brings us to this other option, a charitable trust. And there's a lot of different types of charitable trusts. If you go on the White Coat Investor blog and look up charitable trusts, you will see that there are a whole bunch of them. Crits and cruts, and there's all kinds of different types of them. And a charitable remainder trust is one of the really common types. Basically, what is left after the annuity period goes to the charity. So the annuity period is where you get income from the charitable trust. Okay, so that can go to you, it can go to a family member, whoever. Once the beneficiary dies, whatever's left goes to the charity. And so you get a certain amount of a charitable donation for setting up this trust. The main purpose of doing these is when you want income of some kind. So you have some charitable desires, but you don't necessarily want to give it all to charity, or you want to create kind of a spendthrift trust with it and use some of it to support your family member. A lot of people say the best time to use it is when you actually want to provide more tax benefits than just income tax benefits, right? Because this can reduce the size of your estate as well and reduce your estate taxes. So if you have an estate tax problem, might be a great idea. If you are selling a family business, this can work out really well for you to try to keep that out of your estate and avoid gift tax issues. Those are kinds of people that look into these charitable remainder trusts. If you want to keep it simple and straightforward, you probably prefer more a donor advised fund or a private foundation than you would a charitable trust. But if you start liking the idea of getting some income from it, or you have an estate tax problem, or you're selling a highly appreciated business, then you can start looking at a charitable remainder trust. But just having some appreciated shares of stock or mutual funds, I don't think that's necessarily a reason you got to go look at a CRT. Obviously, those are going to involve an attorney drafting it up. There's going to be some significant expenses there. You're not going to do this for a $50,000, charitable donation. This needs to be something relatively large to justify all the money you're going to spend setting up and maintaining this trust. Hope that's helpful discussion of those different types of charitable vehicles. For most people, I would start with the DAF and see if you can't meet all your needs with that. If you are a particularly wealthy person, or you're starting to worry about estate taxes, or you have a really appreciated business, then maybe start looking into a private foundation, meeting with an attorney, talking about a charitable remainder trust, those sorts of issues. Hope that's helpful for you.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.